Give us the instance analysis. How should I be reading these numbers? Because they seem to be a little contradictory.
Well, great question. And, we have to keep in mind that this is a diffusion index, and we're measuring change, directional change month over month. Therefore, what our respondents are indicating is that they did not hire as much or as many jobs as they did in the prior month, looking at November versus December. And this is typical for the services industry because traditionally, when we look at seasonality for this sector, employment softens in December. It's usually geared up, ramped up in November. I did notice that the retail number was higher, which is typical for the holiday season, but overall, holiday cycle time, everything that's associated with employment, this is not very far off from what we've seen historically.
And let's go to the headline, of course, the services overall decreasing 2.1 points. That's the biggest decrease since March. It's still above 50, which, maybe is a good sign here. But talk to us about that decrease and the worries that this will probably inevitably spark that this is the first step to maybe a broader slowdown here.
As we look at that composite index, the PMI is comprised of four sub-indexes. So the employment index and supplier deliveries index is what's driving or pulling that down, that 2.1%. If you look at business activity, it's actually up 1.5%. And new orders came down slightly. It came down 2.7%, but still it's increasing month over month from November to December. So again, those four indexes, supplier deliveries, employment, new orders, and business activity, equally weighted. That's what comprises that PMI.
Anthony, the market is reading this as a weak number. Yields are dropping on the back of it. We're back below 4% on a 10-year. What you sound like you're saying is that actually, in reality, this is quite a strong number still.
Last year at this time, the sector contracted last December. Now we're looking at 50.6. Again, measuring directional change, we're better than we were the prior month. It's just at a slower rate of growth. So that's the clarification. So it's not that it's a strong rate of growth, it's just a slower rate of growth month over month.
And talk to us a little bit, too, about what we're seeing about inventory levels. That's an interesting detail here. Basically, that sentiment about inventory levels falling nearly 7 points. It had surged in November. Maybe we're seeing a little bit of a reversal right now. When you're looking at that number, what does that tell you about the balance right now between supply and demand?
Great question. The demand has waned slightly, especially year over year. It's down. And capacity improvements in the supply chain have contributed to having to carry less inventory. But typically, the inventory buildup happens before the holiday season. And then as companies look at cash liquidity and year end, they look to correct their inventories and try and drive them down by year end.
Anthony, if you're the Federal Reserve and you're looking at this data, how should you be reading it? The question that everybody's asking themselves now is, do we need to see a March rate cut? Or would May be okay? What do you think? If you were in that chair, what would you be thinking? How would you fold in your data into that conversation?
Putting me on the spot on that one, being the Fed chair, I would definitely look at cutting rates simply because of the impact to the real estate rental and leasing industry, which is the largest contributor to GDP for this sector and the overall economy. And it's been stagnant. And so I believe that with prices moderating, with the index coming down from 58.3 to 57.4, it's still showing, it's moderating. So it's still showing increases month over month, but I definitely would look at a rate cut.
And Anthony, I mean, extrapolating these numbers forward, when you think about what we saw in November, what we're seeing in this round of numbers, what does this say about really the tone that this sets for 2024?
The 2024, we typically see in January that lull a little bit after the holidays, and then it starts to pick up again at the tail end of the month. What our respondents indicated in our semi-annual forecast that was released in December, that they felt that the second half of 2024 would be better than the first half. So we might see a little bit of lag in that first quarter, but I believe that by February we should see all indications of how this sector will be moving into 2024 and the balance of the year.
Final quick question. Inflation. What is the takeaway on the inflation question from this data? The prices paid number remains relatively elevated. 57 is a strong number. I appreciate what you're saying about this being a diffusion index, but what does this tell us about service sector inflation?
To your point, it's definitely, we're seeing price increases month over month. It's just not at that rate that we had seen in the past. I mean, thinking back to when last year at this time, it was still elevated over 60, high 60s. Prior to that, it was in the 70s, almost 80 percentile range on that index. So they're moderating, but yep, we still have to combat some inflation here going forward.